So, in the world of investing, you've got these two big strategies that, on the surface, look like total opposites. Today, we're going to dive into this really weird pairing and figure out why they might actually be a match made in heaven. Let's just frame the big debate right now. Are you the bargain hunter, always digging around for a hidden gem that nobody else sees? Or are you the trend rider, catching that perfect wave at just the right time? It feels like you've got to pick a side. But what if that's the wrong way to think about it entirely? To really get why this whole bargain hunter versus trend rider thing is even a debate, we need to rewind a little bit. Because for a long, long time, how we thought about the market was way, way simpler. For decades, the thinking was pretty straightforward. The only thing that really mattered was the overall risk of the market. That was it. But then, in 1993, two researchers, Fama and French, completely changed the game. They basically proved that other things, what we now call factors, like how big a company is or its value, were huge drivers of returns. This kicked off a whole new era of discovery, and it led us straight to one of our big players today, momentum. Okay, so let's dig into that first big factor that Fama and French pointed out, value. This is the heart and soul of our bargain hunter. At its core, value investing is really just about being a smart shopper. You're trying to figure out what a company is truly worth, its intrinsic value, and then you wait to buy its stock when it's on sale, when the market is offering you a discount. Simple as that. It's about finding fantastic companies for a cheap price. So, does all this bargain hunting actually pay off? Well, historically, the answer is a huge yes. If you look at the data going all the way from 1951 to 2016, the cheapest stocks, the value ones, returned about 15% on average. That absolutely crushed the more expensive stocks, which only scraped by with about 6%. But here's the really interesting part about those high returns. It's not just that you are taking on more risk to get them. Nope. As you can see here, value stocks have historically given investors a much better deal, a high return for the amount of risk you took on. Meanwhile, with expensive stocks, you are often taking on plenty of risk for a pretty underwhelming reward. All right, so that's our bargain hunter strategy. Now, let's completely switch gears and look at the trend rider's playbook, momentum. This has nothing to do with finding a bargain. It's all about hopping on a train that's already moving fast. Momentum is basically built on that old saying, the trend is your friend. The whole idea is that stocks that have been doing really well lately, the winners, tend to keep doing well, at least for a little while. I love this analogy of an accelerating train, just picking up more and more speed as it goes. And you know what? The data here is just as powerful. Over that same time period from 1951 to 2016, the stocks with the strongest momentum, the winners, delivered returns around 16%, leaving the losers way back in the dust at only 6%. So yeah, this is clearly another incredibly strong force in the market. So, we've got two rock-solid strategies, the patient bargain hunter and the fast-moving trend rider. But the real secret, the real magic, isn't about choosing which one is better. It's about what happens when you put them on the same team. So what is the secret? What's the hidden relationship between these two strategies that seem like they should be mortal enemies? Well, here it is. They are negatively correlated. Think of it like a seesaw. When one is up, the other is often down. And if you think about it, it kind of makes sense, right? Value thrives when people are pessimistic, buying up all the stuff nobody loves. Momentum thrives on optimism, buying what's already popular and hot. This means the very conditions that are perfect for a value investor can be a total disaster for a momentum investor, and vice versa. So, what is the payoff? What actually happens when you stop making them compete and you let them work together inside your portfolio? Well, when you combine them, you get this incredible 1-2 punch. The research shows this combo can lead to potentially higher growth. But, and this is the really cool part, it can do that with lower overall risk than if you had just used one or the other by itself. What that really means is you get a much smoother, much less stressful ride for your portfolio. And look, smoothing out that ride isn't just about sleeping better at night. It's actually fighting against this quiet, sneaky force that can really chew up your returns over the long haul. It's something researchers call performance drain. Think about it this way. If your portfolio drops by 20%, you don't need a 20% gain to get back to even, you need a 25% gain. Those big swings create a mathematical drag on your growth. And the numbers show it. A little volatility doesn't cost much, but at 20% volatility, that drag can cost you a whopping 2% every single year. By smoothing out the journey, this value and momentum team helps plug that leak. So, the takeaway here is actually pretty simple and, well, kind of beautiful. You don't have to choose between the bargain hunter and the trend rider. In fact, you have the power to marry them and let them live happily and very productively together in your portfolio. This whole thing really shows a powerful principle that goes way beyond just investing. It kind of makes you wonder, doesn't it? What other things in life that we think of as total opposites, like patience and action or logic and creativity, are actually way more powerful when you bring them together? Definitely something to think about.